Hi everyone, welcome to the fourth video from Node Startup Hipsters. This one is a little bit more involved than the ones we've gone through so far. It's about knowing your cash flow and knowing how to pick a business model and what every business model decision actually looks like in terms of running your company and how much money you should raise. So let's start out first looking at how should you represent your cash flow and what that cash flow schedule actually looks like. So if you observe this curve in the orange, that's kind of what a typical startup's cash flow looks like. First, you burn down pretty quickly and keep losing cash. You get to this first date where you have your first positive cash flow. The tangent on this curve is your burn rate. The axis for this graph is your cumulative cash flow from day zero and time as you grow your company. After you have the first positive cash flow, you'll notice that the slope of the curve starts getting positive, and then you reach a point in time in the future where you're breaking even. The lowest point on this curve is the maximum financing that you need to go and raise from investors. Why is this such a powerful tool? Now let's look at two other interesting curves. If you see the sharper blue curve, and then you watch this more mellow green curve. These are what the business models of the same startup practicing two separate business models might look like. Let's imagine a startup which deals with medical devices. What it actually does is in the green business model, it just sells them. So when it sells the medical devices, it doesn't have that high a burn rate. All it needs to do is make enough footfall calls and slowly start selling. As its brand gets more established, it will start making money a little later into the future, since it takes more time to acquire users with the speed it's growing, and then gently starts making money back. And this whole process may or may not hit that high a total cash flow for that company. Now let's look at the second kind of a business model where it actually gives them away. Imagine this is a modern medical device of analyzing, let's say, stem cells. So it can figure out what's the best organic regeneration for your specific condition, whether it's a broken limb or a cancerous organ. In this situation, what the startup initially does is it gives away a lot of these devices to a lot of hospitals and clinicians and physicians to just use. So the burn rate at the start, if you look at the slope of this line, is extremely high. And the max financing they need is also way higher than the model where they just sell to get money back. But after giving away, once they have captured market share, and there's almost all these institutions using their devices, they can start charging for other kinds of fees, or they could be for analytics, or they could be at a place where you get the device free for a year. If you like to keep it after a year, you got to pay them. Otherwise, you have to turn the device back. So when they follow business models like that, they also bounce up very quickly. But overall risk of that business model is quite high. And where the previous startup business model could get away maybe with $1 million, $1.5 million, this might end up needing $10 to $15 million. So this tool here is extremely useful for you to figure out in your head, what do different business model decisions really look like? From a cash flow perspective, on a day-to-day basis, how much money do you need to raise? What's your burn rate that you can sustain? And what's the day that you're going to break even and start generating positive cash flow? So have you thought about what is really the nature of your profit engine? Have a nice day.